I'm Dru Stevenson, and this is a video for my Law and Economics seminar course. This is part 2 of introducing property law and economics. I hope my students will watch the first video before this, where I introduce some basics about bargaining and the different values that people put on different types of property, and ended with a little note about Adam Smith saying that the foundations of all economies are land and labor. But here in this video, we're going to be talking about something that's a little more in depth about valuation, and in both present and future valuation for property. Now, of course, in your property class, you learned a lot of the legal rules about property, estates and land, like fee simple, absolute, and so forth, and adverse possession, and title transfer, and race jurisdictions, and things like that. And all of those can either depend in part on assumptions about the property values, or can affect what people assume about property values or future property values. So let's take a look here. In theory, the present price in a fully informed competitive market of any item, whether we're talking about land or chattel, should reflect the discounted expected future value of prospective buyers. And that could be the use and or the appreciation value. And by appreciate, I don't mean like I appreciate you as my students, or I hope you appreciate me as a professor making these videos. We're talking about appreciation in terms of resale price, right? So the present price reflects expectations by prospective sellers and buyers, both parties to a transaction, about the profitability of the transaction for them, and or price increases or decreases in the future. So expected appreciation is the idea that usually, let's say land property values go up over time in a lot of places, especially if the population increases. Now, if you've studied the census results from in recent years, you know that we have parts of the country, some rural areas, where the where the population is actually declining pretty rapidly. And that can cause land values to go down, right? But if you think about a population that's growing, those people need places to live and places to work, and so those workplaces need land. And so the land becomes more scarce as there are more people, or an area is more crowded. And remember that external changes in the neighborhood can also result in increases in property. So a new highway, right? So you might not want to live right on the highway, right? A lot of times you studied highways in your first year property courses when you were talking about eminent domain. But let's say you live in a rural area of a state, and the federal government or the state are putting a new interstate highway through, and it's going to be a mile from your house. So this doesn't really interfere with the quiet enjoyment of your property, but it actually probably makes your property a lot more valuable, because there's going to be a need for gas stations. People are going to put in new developments, and if you produce stuff on your property, it's going to be faster to get it to market. Or you could live in that house if you're only a mile from the highway, and maybe commute to a job in a nearby city. So usually a new highway coming through, or expanding the lanes of a highway, will raise the property values, not the ones that touch the highway, but maybe the ones a little further away. And then also someone who's buying land and putting in housing developments, right? So even if your land is not conducive to housing, maybe it's conducive to a shopping plaza, or a church, or some other place of employment, a school, that we're going to need for all those people that are moving into the new housing development. Keep in mind that expected changes in the law, or anticipated changes, can affect the expected future prices, which then in turn will get reflected in what people are currently willing to pay, and so the current sale prices. So in your tax courses, you may have studied capital gains tax. And so if you buy an item, and it could be land, or it could be sort of an intangible type of property like stocks and bonds, and then you sell it later when you buy low and you sell when the market is high, good for you, you made a profit. But we have a special tax rate that's different than the rate that we tax your like wages for your salary, for basically the income you get for your labor. So that we call this unearned income because it's not related to the actual labor we do that you did. It's because you bought low and sold high. Maybe that took a long time, or maybe it didn't take much time at all because you were investing in a wildly fluctuating commodity like cryptocurrency. It could also remember that the IRS over the years has changed its mind about tax deductions for your other income for depreciation on your property. And so that back in the 1980s, we had what we called tax shelters, where if you wanted to offset your earnings and claim a tax deduction, you could buy a parcel of real estate, and then the depreciation deductions were really steep, which meant you got a big tax write-off, a kind of an undeservedly large tax write-off. Changes in zoning and things like that can affect the future expected value of the property. Now, let's talk about the resale value, which is necessarily in the future. And I might have mentioned a moment ago that both the buyer and seller are, when they're estimating values in the future, they're discounting by time. And some of this could be money, right? So if you are thinking about buying something, something in your mind might be saying, but what if I need this, really need this money next week for something else, right? But now let's talk about a long time. So $1,000 today is worth more than an expectation of getting that same $1,000 20 years from now. So let's say that we have an award, a prize for getting the high grade in my class. We don't, but we did have this once before when I taught environmental law. There was a private foundation that would give a cash prize to whoever got the high grade in class. And so the hypothetical I would pose to students would be, would you prefer to have $1,000 today, or I'll hold on to that $1,000 for you and give you $1,000 20 years from now? Well, everybody, there's no, it would say, just give me the $1,000 now. I'll hold on to it. Maybe I could put it in the bank and it could grow. It should be more than $1,000 20 years from now. This may remind you of a parable in the Bible about earning interest in the Gospels. So, but let's change the equation a little bit. Let's say that I would give you $5,000 or $10,000 20 years from now. Well, now the class starts to change their minds, right? And it's not evenly split. There's still some people that want the $1,000 now, either because they're desperate, they need it, or they think that they could do better than that. And then there's other people who are doing the math in their heads. And at some point I hit a number where they realize that's actually a really good rate of return. So estimates for how much to discount for future values vary quite a bit, person to person, or company to company, or bank to bank. Now, don't confuse this with things that you may have heard about in the past, like the rule of 72 or something like that, which is a sort of a shorthand way to calculate things when you know the interest rate, right? So if you have a bank account or some sort of investment and a guaranteed interest rate, then there are some shorthand things like the rule of 72 for calculating how much that will be worth in 7 years or 14 years or 21 years or something like that at a given interest rate. We're not talking about that now. We're talking about people kind of estimating how much a dollar is going to be worth. Will America even be here? Will we still be using dollars, or will we all be using Bitcoin by then? The value of the dollar actually fluctuates year to year in relation to other currencies. As you know, sometimes we have price inflation, and it's very complicated. And there's debates between economists about whether inflation is caused. The old school economists think inflation is caused by the federal deficit and spending too much and printing too much money, they say. Modern monetary theory says the deficit actually doesn't cause inflation. It's usually spikes in demand or disruptions in supply and things like that. So, but keep in mind that you can have inflation, which affects the value of the dollar. Other countries' currencies can affect the strength of the dollar. Market demands can fluctuate. So you could have a stock market crash. You could have massive unemployment, like during the Great Depression, or things like that. So it's hard to predict. Some people feel like they're really good at predicting the future, but the fact is, no one really knows what's going to happen. We are all going to have things that catch us off guard. Even if you get some predictions absolutely right, you can write a book and go on all the news shows saying, I called it, I called the stock market crash. But the fact is, there's going to be some things that catch you off guard. Now, Let's talk about property valuation, not just in terms of future value, resale values, but use values. Sometimes certain types of property are going to generate income for the owner every year. So, for example, land can be farmed or rented out. Stock dividends. So, a lot of stocks and bonds pay annual dividends. So, you kind of get basically some cash dividends, a check, because you own that stock. If you own patents, maybe you're leasing those patents to various manufacturers for that product, or you have a copyright in something like a book, and so you get royalties every year. We also, so if we're going to talk about, are you thinking about buying land, you're going to do some math equations to figure out, well, I think this will generate a certain amount of income every year, but of course, $1,000 from the land in 20 years is a little less than it is this year. And so people have ways of calculating what the current value of future earnings on some sort of property, whether it's land or stock dividends or things like that, would be. And similarly, there could be a value just from use. So for example, let's say your residence. So you're actually getting some value because now you have a place to live. A lot of you at some point spent a few $100s or maybe a couple thousand on your computer, and you use it all the time. You need it, and you're going to use it until it breaks. Let's say some of you are musicians, and so you've bought a musical instrument that you play all the time, or you have a car or a truck that you drive. And so in that sense, that's something that you're getting value, and part of the market value is going to reflect how useful that item is. That's a little different from generating income. Now, I do want you to recognize that there are some types of property that are not that useful, right? And they aren't going to generate income don't spit out dollars at you like stock dividends. And those are going to derive their present value mostly from their expected appreciation in the future or resale price. And so fine art is an example. So maybe you like looking at the art, but the fact is, if you're an art collector and you buy a lot of it, that you are not it's still valuable. The value doesn't depend on whether you look at it every given day. Do you look at it once a week or every day? How much do you enjoy it after you've been looking at the same piece of art for 10 years? None of that really matters because it was an investment. You expect to be able to sell it for more in the future. Collectibles, right? Like rare baseball cards and rare comic books, gold bars, precious metals, or antiques, or firearms. A lot of gun owners buy guns, really believe, if you talk to them, that any gun they buy, a new gun will never depreciate in value. They'll always be able to resell it for what they paid for it, or maybe more, and maybe make a profit. That's the theory. I'm not sure that's always true. I think a lot of people get desperate and take their guns to pawn shops in the end, and take a loss. But the idea in theory in the gun community is that firearms don't depreciate. Note that these types of items that you are expected to just hold for a while and then sell when either the market is high or that item has appreciated, like a bottle of wine that has aged or something. But a lot of these are not consumable goods, right? You're just keeping it sort of in storage and waiting for the price to go up. You're not using it the way that you drive your car until you run it into the ground. Now, let's talk, since we're talking about cars, it may be tempting, if you haven't really thought about things much before with valuation and prices, to think that the price of an item merely reflects its cost of production. In other words, let's say this car here, the cost of the raw materials, the metal and plastic that goes in, and glass that goes into it, the labor required, all the people at the factory who make the car and put it together, and maybe the overhead costs for the production facilities for the factory. And so that's going to be everything from the light bill and electric bill to the cost of having a factory. But the fact is that these actually don't control the price, because you could have $100,000 car that they made too many of and nobody wants it, and so you can't give those cars away, right? And certain situations, and so the current price, in theory, should be what the people are actually willing to pay, not what it costs the seller to acquire that item for sale. On the other hand, All of these things, cost of raw materials, the labor required for production, and overhead costs, can influence the market value in terms of replacement costs, but not for producing this unit that's already there with a price tag on it. In other words, if it's really, really expensive to produce something like that kind of coffee that has to be eaten and digested and then pooped out by cervets in Malaysia or someplace like that, or a very expensive coffee, a very expensive car that's super expensive to produce, that means that there's presumably going to be a scarcity because it's so hard to make them. We're not going to have a surplus of them on the market. And so the fact that they're costly to produce may mean help guarantee future scarcity. But again, the current market price should be what people are willing to pay, or what you're willing to sell it for, not just what it costs to produce. Now, let's talk about usage, right, for things like homes and computers and cars. The way we derive values from that, or if you think about what were you willing to pay to own a home, is you're probably comparing it to how much you're going to save on rent if you don't buy, right? So there's always an alternative to owning your own thing, right? You can borrow or rent items. And so forth. When you think about usage in terms of chattel, like tools or computers or cameras and so forth, these increase productivity, they save time, they help you produce higher quality, and can therefore either increase your profitability or increase your free time. Let's go back and talk for just a moment about capital gains. I mentioned it before that if capital gains are expected to increase or decrease the taxes on it, that could affect your valuation of the current sale price, right? So if you expect Congress at some point to double the rate of capital gains tax, that might deter you from going on a buying spree for investment properties, in theory. And so note that we could have a lot of debates about how the capital gains tax affects current market values. This is something economists can study and debate about, and it's not always clear that there's a one-to-one correlation. Also think about whether capital gains is a use tax or an appreciation tax. Most people would consider it an appreciation tax, basically that this was investment income. You bought low, sold high. And so forth. But we could think about the fact that you're buying low, holding it, and selling it high is depriving somebody else of buying that in the meantime. And in that sense, is it a tax on their inability to use the item in some sense? It's just a point for discussion. Okay, last point, and then we're done with this video. Speculation and hoarding. I've been talking about buying low and selling high with things like stocks or land. And sometimes this is very benign, right? That you have good intentions. You have a little bit of investment income, and so you buy a parcel of land or buy some stocks, and you expect to just sit on it. It's an investment, and you figure you'll either wait for the price to go up or the market to go up and sell it later and get a little profit, or you're going to save it for retirement or some future event. You're going to cash it out when it's for your wedding or for a big trip or something like that. But there's a more sinister type of speculating and holding that I want you to think about. And this is that when you have someone who has a lot of investment income and they can go on a buying spree that's designed to manipulate the market price. In other words, to send a signal to everyone else that an item is selling rapidly, and so everyone else raises their price. And if you've already cornered the market on some resource, whether it's the land in an area or some collectible, you've bought all the 1957 Hank Aaron baseball cards, certain types of precious metals. Back in the 1970s or 80s, there was a family in Texas that basically caused the silver market to go haywire because they went on a buying spree and intentionally drove the price up. They were able to buy enough that the stuff they bought then became worth more because of the market's reaction to their buying spree. You may have heard that the De Beers diamond company hoards a large reserve of diamonds to keep the price of diamonds artificially high so that they'll be considered precious. This has happened in the past with raw materials for manufacturing, where someone is able to corner the market on something to speculate. They had a lot of money, and then essentially to exert monopoly power and jack up the price when they decide to sell it. So we usually talk about monopolies with corporations and transactions and a market for production, like for a monopoly in manufacturing and sales. But I want you to think about that you can have a similar monopoly effect if someone just buys up stuff, basically property, and it could be land and it could be personal property, and hoards it to basically make a profit because they manipulated the market with their buying spree. And that concludes my second video about the economic analysis of property and property law.